Okay, we are going to work some problems about chapter 2 from the Heintz 23rd edition. And so you'll see these problem question numbers I have that I'm going to plan to work through. And I might stop it and start a new video if it gets too long, but I'll try to just run through them and see how long it takes. But these are some like your homework, but they're not exactly the same because you have a different generation of numbers. So let's just see what we can do with these. The first one is talking about the accounting equation, and it's just playing off the fact that we already know that assets equals liabilities plus equity. So if we know 2 of those numbers out of 3, then we can find the other one. So if we know that liabilities is $27,000 and owner's equity is 17, then we know we can just add those 2 together to get the total assets number, which I think that's going to be 44,000. Okay. And then for owner's equity, if we have the missing piece being owner's equity and we know assets is 32, we can just subtract 18,000 from both sides and we wind up getting a total of $27,000 for owner's equity. So we're just going to put these in, and in a minute I'll check my work and see, I might get one of those glitches too because I'm just messing around here. The third one is talking about if we know, oh, I'm sorry, I'm wrong already. It's not 27,000. 32,000 minus 18, 14,000. And 27, I'm looking at the wrong numbers. 27, if we know that total assets is 27 and we know that owner's equity is 20, then that's telling us right there that liabilities has to be 7 because we have to have both sides equaling each other because as we talked about in the lecture video, liabilities and owner's equity total combined always equal the assets because for every asset the company has, there is a claim against those assets by either the creditors, which is the liabilities, or the owners, which is the owner's equity. Now, let me see, it's going to be nice to me now. I'll check my work and we'll see what it says. Yep, got a little check mark by each one. So it's all good. Yay. So that is exercise 2.2a. These are just from the back of the chapter. I'm doing them in Cengage, but they're the same problems that are in the chapter starting in the book, starting on page 42. So we're going straight down the line for a few problems. So this one is John Sullivan starting a business. During the first month, the following transactions occurred. Show the effect of each transaction on the accounting equation. So if it increased assets, we're going to put the number under the assets with a positive. If it decreased assets, we'll put parentheses around it or a negative in front of it. It says after the transaction, show the new totals. Use the minus sign to indicate the decrease or reduction. Okay, so not parentheses around, and a minus sign. If an amount box does not require an entry, just leave it blank. So the first thing, we invested cash in the business of $27,000. That increased the assets, and that means owner's equity increased too. The owners increased a new balance. I'm sorry, increased their equity. Let's just look at the next line. New balance does not calculate automatically for me. Unfortunately, I have to add it each time. So we got that one. So that's the A part, I think. Here, if you're not sure, even in the middle of your problem, you can click check my work and see if it'll give us tell us that we're correct or not. Yes, see those check marks? It's all good. Then the second thing that happened, we bought office equipment on account $7,500. So since we bought office equipment, it means we increased assets. And then just notice it did not say we paid for them. It said we bought them on account. That means we increased our liability. We still owe for them. So we have a liability that we owe the vendor, $7,500, and equity did not change. Now, the only thing, that's happened to equity, to liabilities, it's just that very thing. And we did not change the equity, so it's still 27,000. We did increase the assets, so it should be 34.5 now. See, I'm just going through and updating what's the total assets now. And then if at any point, if I look at the balance, it should always be that the liabilities and equity still equal the asset accounts. So 27,000 and 7,500 brings me to 34,500. So I know that after transaction B, I'm great. I'm still in good shape. Okay, see, we bought office equipment for cash. That's when they say you bought it for cash or you paid cash, you know your cash is decreasing. You're not trying to increase your liability by just buying it on credit. It was $1,600, and it says enter the cash, the change in cash on the first line and the change in equipment on the second. They're just telling you put the cash entry first or it's going to glitch on you. So there's going to be a $1,600 decrease in assets and a $1,600 increase because both cash and office equipment are assets or resources of the company. So one is increasing the assets and one is decreasing. So the net effect is no change on the total assets and nothing happened to liabilities or equity. Now that was what you call a compound entry. And so, well, it was not an entry yet, but that's a compound transaction as far as two lines on the asset accounts. Okay, I think we're still good, but I don't know how many check marks I have. So I'm going to just hold off until I do all of them. I think I have 3. All right, so D. The D transaction says paid cash on account to suppliers in transaction B. Then we like scratch our head. We look back up at transaction B and said, uh-oh, what happened in transaction B? So I look back and I said, oh yeah, we bought that office equipment on account. Okay, great. I'm going to pay for some of it. So I'm going to pay $2,300 on that. So if I'm going to pay, it always means my cash is going down. I'm going to decrease cash by $2,300. And I'm going to decrease that liability by $2,300 because I'm not going to owe $7,500 anymore because I just decreased it. I paid $2,300 on it. So all I owe now on the liability is $5,200. So that changed my ending liability account. Nothing happened to my equity account. And my cash account went from 34,500. Yes, my cash account did too. But my assets total, it included that cash account, went down by from 34,500 down by 2,300. So that put me at 32,200. So I'll look at the numbers and see if they still balance, see if the asset total is still the same as the liabilities plus the equity. Okay, 27,000 and 52,200. That would be 32,200. And there's the assets at 32,200. I'm a genius. This is all good, right? That's what you tell yourself. You're like, you just have to give yourself a little encouragement when you get it right. And accounting does that for you because it gives you these balances. And where if you get an assets equals liabilities and equity, you like congratulate yourself. It's really a good idea. Okay, let's check out my work before we submit that. Yeah, got the little check marks everywhere. It's all good. And they give you some explanations down here sometimes. Not always. Well, it's always something, but not necessarily always very helpful. But sometimes it is. So that's good. We did that one. Now let's go on down to the next one. 2.4a, which is like your 2.4b that's going to be in your homework. What we've got is the effect of the transactions. Assume that John Sullivan, same guy, completed the following additional transactions during February. E, we just did D. They gave us the beginning balances we just had. Remember that? These were our 3 balances on the last problem. Okay, and so it said he received cash from a client for professional services. So they're having us expand our thought a little bit to see, what if the transaction doesn't just affect total assets, liabilities, and capital, but it affects these temporary accounts that are happening just this year. The revenue expenses are drawing. So the first one was this 1,500 cash. If it says we receive cash, it means we're going to add. In other words, increase the cash. And then the other thing is it was for that professional services. So that's a revenue item. So that increases the revenue. And so we are going to look at the pull down menu, see what the options are. See, service fees is the only one that's talking about revenue. So we know that's right. Then that's E. F, paid office rent for February, $600. Oh, we paid something. That tells me that it's going to be a negative $600. $600 we paid means $600 decreasing in assets. And if you're dealing with just the cash account, it would be $600 decrease. We paid the rent for February. Is this February that we're working? Yes, it's for the current month. So it's going to be an expense. You don't put a negative on it when it's an expense because expenses always decrease capital. So it's all good. Just leave it as a positive number because it's just a normal rent transaction. It's increasing expenses, which we do know decrease equity. And then the next one, G, paid February phone bill. We paid something. That means cash went out. As soon as you see the part you know, just enter that. You don't have to do it in a certain order. It doesn't have to be the assets first, but if you know what that means, if you paid something, that's decreasing your cash. And so the one that I always do first is the one that makes the most sense to me. It's the most logical right away. So that what did we pay now? That's the other part. The phone bill, it's an expense. So we're going to pay, and it's for February again. So it's a current month's phone bill, phone expense. Okay, great. Now H, withdrew cash for personal use. Okay. So if you withdrew cash, it means the assets just decreased. Decreased assets. Every time we pay out some money, withdrawing money is paying out money. And it's called drawing or withdrawing. And again, it's an automatic, everyone knows, it's understood that just like with expenses, that drawing decreases the equity counts. So it's just drawing. Drawing is always a decrease in the equity. So you don't have to put a negative in front of it. They don't even want a description on that. I guess they think it's self-explanatory. Now, the next thing, it's I, okay? Performed services for clients on account. Okay, when they say they perform service on account, they're telling you they did not pay us yet. So what we've got is we're going to have an accounts receivable from that client, but that's still an asset. So we're still going to put an increase in assets. So it's $750. And it's a revenue item. So it's going to increase revenue by $750. Okay, and we're going to call that service fees again because that's what it is. If you're making revenue, if it's a service company, they usually call it service revenue or service fees, or sometimes professional fees, professional fee revenue. I would wish they would always put the word revenue on it, but they just. All right, next is J, paid wages to part-time employees. If we paid something, our assets just went down because cash went down. So we're going to put minus $1,200 for those wages. And we're going to put an expense of $1,200 for those wages. And there's the choices. We're going to take wage expense. That makes sense, doesn't it? K, received cash. I don't have to read the rest. I can put half the entry already. Half the entry is I received cash. How much? $400. So I increase the asset account by $400. And what did I get it for? That's the only way I'll know what to do with the next one. For services performed in transaction I. What happened in transaction I? Let's go back and look. Oh yeah, perform services for clients on account. All right, so that's an accounts receivable I'm collecting on. So that's not going to affect any of these other things. It's only going to affect cash and accounts receivable. So only going to affect assets is what she said. So it's an increase in assets that are called cash, and it's a decrease in assets that are called accounts receivable. So they don't even ask for an explanation of that one either. So now what they want us to do is summarize what's the totals now. So take the easy ones first. Liabilities is still $5,200 because we didn't change it. See how all these entries that we made here are going to affect the bottom line balance? We started with these three balances. No balances in any of these three. So all of those, we can just tally up what changes we made. Drawing only had one entry, and it was the 1,000. Nothing happened to the capital account during these transactions. Revenues had two transactions, 15,000 and 750. So that's 2,250, isn't it? And expenses had three transactions, 1,200, 664. So that's 1,864, I think. All right, so the only thing we don't know now is what happened to the assets because a lot of transactions happen to assets. We started with 32.2 right here. And then we added 1,500, subtracted 600, subtracted 64, subtracted 1,000, added 750, subtracted 1,200, added 400, and subtracted 400. So I'm going to just go ahead and put the number in because I already got that number, 31,586. And all that is a summary of this beginning balance and all these things we changed. So now to double check it before we do anything else, we can add up each of these things. We can say the asset total is 31,586. So the total of all of the claims should also equal 31,586. So that means I should be able to take liabilities and capital and subtract from that drawing and add revenue, subtract expenses, because I should go by this little formula up here that we've been talking about. The equity section is capital minus drawing plus revenue minus expenses. So when I take 5,200 plus 27,000 minus 1,000 plus 2,250 minus 1,864, I'm still going to come to 31,586. Now that all assumes I entered everything without transposing a number. Let me just check my work. Now let's look at it. See those little check marks? Those are so beautiful. You check, you see those check marks, you're like, yes, because you got it. And so now you can look at it and answer these other questions. Demonstrate the accounting equation remains in balance. That's what we just did by talking through it. 31,586 was the assets. Total liabilities was 5,200. I'm pulling from my spreadsheet. You see that, right? For these two numbers right here so far. The capital was 27,000. The drawing was 1,000. And it's a reduction, so let's put a minus on it. Now, the reason we're putting a minus on it now is because we're saying what does it do to the total claim side of the accounting equation. And then 2,250 for the revenue, and then a negative 1,864 because of its impact. That's the impact it's having on equity. So the total claims is the total liabilities and equity, and that's going to be that same 31,586. So again, beautiful little check marks. I congratulate myself and say, yes, conquered. Okay, the next one. This is what we call a list. Oh, wait a second. I'll just read it first before I go too crazy. Label each of the following as asset, liability, owner's equity, revenue, or expense. Indicate the financial statement on which the account belongs. Income statement, statement of owner's equity, or balance sheet. Okay, so we're going to start with cash. We already know that cash is an asset, and assets always go on the balance sheet. So this is a piece of cake once you figure out those elements that we talked about in the lecture. Rent expense is an expense account. It goes on the income statement. Revenues and expenses and gains or losses go on the income statement. Assets, liabilities, and equity, capital accounts, go on the balance sheet. So here's accounts payable. It's a liability. It goes on the balance sheet. Service fees is a revenue account, and it goes on the income statement. Supplies. Now, when they say the word supplies, they're not talking about an expense supplies. They're talking about an inventory account. That's an asset. So this would be like the supplies that are in the closet on purchased in advance that can be used later to help us make our money, make our revenue. So that's a balance sheet account, an asset called supplies. If they said supplies expense, you would put it as an expense on the income statement. Wage expense is an expense, and it goes on the income statement. Raymond Martinez drawing, that is an equity account, and it goes on. It goes on the statement of owner's equity. Just make sure where they put it. Yep, capital is an equity account, and it goes on the statement of owner's equity and on the balance sheet, because it's the one thing that crosses over from the statement of owner's equity, and it feeds into the balance sheet from the statement of owner's equity. We'll get some more detail about that later. The prepaid insurance is another asset account. It's where if you see the word prepaid, it means they paid something for a future period. So that's an asset on our balance sheet. Accounts receivable is where the client owes us. That's an asset on the balance sheet also. Now, I did this pretty quick, so let me just check and see if I missed anything. Oh, no. Oh, that's funny. Prepaid insurance, if it said interest expense, then it would have been an expense. But as you know, I knew it was an asset, but I touched the wrong key. So be careful. If you're doing your touch screen, there's some downsides to using this touch screen. Prepaid insurance, when you pay it for a future period, is an asset account on the balance sheet. Yeah, now it's good. All right. Then we're going to number 6. This is a statement of owner's equity. And this is a different scenario totally. But what is telling you, a new scenario is telling you that Betsy Ray started an accounting service on June 1st by investing $20,000. Her net income for the month was $10,000 and she withdrew $8,000. So owner's equity works like this. A statement of owner's equity starts with what was the beginning equity account. So she just began this practice. So her beginning equity account is going to be 0. Then we're going to add to that whatever she invested in and into the company, which would be her contribution, her capital contribution. And then we're going to also add the net income that she earned this period. And we're going to subtract any drawings that she would have made. So we're going to start out with her beginning balance, capital on January 1st. And it's going to be 0 because it told us in the problem, so I knew that she started an accounting practice or accounting service. That means that she had not had a history where she would have a beginning balance of capital coming in. Then we're going to add the investments that she made. It's increase in capital. And it said that she increased the capital by investing $20,000 in the company. Okay, so her total investment is $20,000 because she didn't have a beginning balance. Then we're going to go from there and add the net income for this period. They told us how much it was. Net income for the month is $10,000. And then we're going to reduce by the amount of withdrawals she made. She withdrew $8,000 of those earnings. So the net increase in capital, her net income minus her withdrawals is $2,000. So she started out with no equity. She put $20,000 in, and then between the amount that she earned this period and the amount she withdrew of it, she had $2,000 left that she left to be retained in the company. So that retained $2,000 is going to be added to the $20,000 that she invested. So she's going to wind up with $22,000 in capital at the end of the period. And so that's what we're going to call Betsy Ray Capital on June 30th. That looks beautiful. Now, let me make sure I haven't done something crazy. I'm going to go ahead and check my work. Even though I feel pretty confident about it, I'm still going to use this check my work because it's free. That's funny. I missed something. You see, this is very good experience for me because I know how this stuff works and I still sometimes miss something. All right, investment. Oh, rather than calling it an increase in capital, which it is, I was supposed to choose an investment during June. So this is actually really good experience to see me do something crazy too, because it's just normal. If you pick something that sounds close and it's actually still true, that's not what they were looking for. So that's why check my work is very valuable. So let's try again now, see if it'll be nice to me. Yes, finally the check mark. So I go, sometimes whenever you have a problem and you get the little by getting a little X, it's like, what? And so you get a little reaction, but it's okay because as long as you conquer it and you still get it, then you see this really pretty, all the check marks. You're like, yes, I did it. I conquered it. Okay. So now what I've got is I've got 4 transactions. 4 different pieces of a scenario that has like A through G transactions. I'm going to take those transactions and do just like we did with our earlier problem and post them as what effect they had on the accounting equation and on specific accounts within the accounting equation. And then I'm going to follow through by taking that down to, I'm sorry, I'm just trying to find the problem in my notes too. I'm going to do this worksheet to see what's the effect of these transactions. Then I'm going to take my result and push it through the different financial statements. So that's what we're going to do now. So let me just take one piece at a time. Not spend a lot of time. You can always pause my video and start over, listen to it again, pause it and work it yourself and then check it by mind. That would be great. Okay, the first one. All right, well, let's talk about it first. Jay Pembroke started a business during the first month. Oh, that's telling us there's 0 balances and everything. So the first month, April, he invested cash in the business and it was $18,000. So cash increased and his equity increased. his capital. Okay, that look right? They don't ask for a description. B, he bought office supplies. That means he's going to show us an asset account of $4,600 for $2,000 cash and $2,600 on account. Oh, so yeah, that is a compound entry. So he bought $4,600 worth of assets, office supplies, not expense, and he paid for it by $2,000 cash, which he paid now. So we're going to decrease cash, not $2,200, by $2,000, and we're going to promise to pay him the rest of it, pay the supplier the rest of it, $2,600 later. So that's what that means is we had bought office supplies, $4,600, and we paid $2,000 cash. And when we promised to pay the other $2,600. So that's what this transaction is, 3 pieces, but they take care of the whole problem. So the accounting equation is still in balance because you see the assets end right here. The assets are cash plus accounts receivable plus office supplies plus prepaid insurance. So the entry we just made is a net $2,600 to the assets. And then the same entry is a net $2,600 to the liabilities and equity side because accounts payable is a liability. Okay, everybody's cool? If not, go back and listen to it. Go back and look at some examples in the book. So I know you can read, so I'm not trying to read what the book does. I'm trying to give you another way of thinking of it that is doing the same thing. Okay, C, the next transaction, paid 1-year insurance premium. Now, if you pay insurance for a year, you are paying in advance, right? Because insurance companies they won't give you coverage without you paying the premium in advance. So you pretty well know every time you pay an insurance premium that it is for a future period. And so whenever you pay insurance, you're going to code it to prepaid insurance. And how much was it again? Let's see, $1,200. And so your cash went down by $1,200 and your prepaid insurance went up by $1,200. Okay. Then the next one, bought office, no, let me go up so I can see. Earned revenues totaling $3,300. They paid us $13,000 in cash and they promised to pay us the other $2,000. So we have an increase in cash of $1,300. We have an increase in accounts receivable of $2,000. That's where we track the amount the customers owe us, accounts receivable. That means we're going to receive it in the future. That's why it's called accounts receivable. By the same token, accounts payable is something we're going to pay in the future. So we're keeping track of the account, the balance that we're going to pay in the future. That's why we call it accounts payable. If it's something we owe, we call it accounts receivable. If it's something that we're going to receive in the future. Okay, so I got the 2 payments, the 2 pieces to this client's payment. They gave us $1,300 and they promised to pay the other 2 later. So we coded that to accounts receivable. And then the other half of the entry is to show the revenue. It's $3,300. We know it's going to be a revenue account because it says we earned revenue. So we're going to put it to $3,300 credit to the revenue. Oh, except we shouldn't put it up there. Do you see where I put it? Got to be careful with going along the line. I just put it up there on the transaction C. That was going to give me a nastogram, wasn't it? It was going to be the big old red X. So that wouldn't be nice. So E, paid cash on account to the company that supplied the office supplies in transaction B. Oh, yeah, look here. We owed them $2,600. So now we're going to pay them. We're going to pay them $2,000. No, we're going to pay them $2,300. So let's go down here to transaction E. We're going to reduce this accounts payable. And again, you'd see I'm not necessarily starting with cash. I'm starting with the one that makes most sense to me right then. I totally understand that I'm paying some of that accounts payable, so I'm going to reduce it right away. And what happened to my cash? Cash increase or decrease? If you see the word paid, you know cash decreased. $2,300. So that makes that line in balance. So we're good. So now we're on F. Paid office rent for the month. If we paid something, our cash just decreased. So we're going to negative $750. You have to watch what you're doing. You see that? Okay. And so we paid. And so then again, I tell myself, what did I just pay? $750. What was it for? You look back at the data. You say, oh, yeah, office rent. So that's an expense. You paid office rent. And of course, when you're paying expenses, they're going to be put in as positives. When you're recording them, they're positive entries. Whenever you're saying what is the impact they had on equity, it's a reduction in equity. But track the expense is just always increasing the expense and knowing that that expense account in total is going to decrease equity later. Okay, and then the G transaction, withdrew cash for personal use. So that means cash is decreased. How much? $100. And that, if they withdrew cash, that's drawings. So we're going to take drawing again, like expenses. You just track it with the actual amount. Click over here instead of just pointing at it. All right, let's look at it. Make sure it's all balanced, each line. I'm just going through each one, tracking it to make sure the numbers are equal on each line so that I'm still being balanced, because otherwise I won't be in balance. Yeah. Okay, it's all looking good. So let me go ahead and tally it up. And so let's see what they want for these descriptions. On transaction D, they wanted a description and we were earning revenue. So let's go ahead and tell them we're earning revenue, service fees. Then on transaction F, they want a description, paid office rent. So they want us to say rent expense of it. Yeah. Okay, so now the only thing we have to do here is total these. And so I go easy ones first. If there's only one entry, let me get that one first. Accounts receivable was just one entry. Office supplies is just one entry. Prepaid insurance, just one entry. Capital account, just one entry. I'm just summarizing. The drawing account, just one entry. The revenue, just one entry. The expenses, just one entry. And then I go back to the one that has just two entries now. I have the accounts payable. So the ending accounts payable balance started out, the first entry we made was 2,600. Then it reduced it by 23 when we made the payment. So the balance now is 300, right? Okay. And so then the only other one I need is the cash account. And that's the one that has the most activity. So I had an $18,000 increase, then 2,000 decrease, 1,200 decrease, 1,300 increase, 2,300 decrease, 750 decrease, and a $100. That was a decrease because that was back there where we paid out our that withdrew cash. It's a decrease. And so, but net transactions, if you total all those up, it's going to be 12,950. And that's just a summary of that column. Okay. Now there's always a chance that I did something crazy, but we're going to give it a shot with our check my work before we go beating our head against our hand against our head. And if that way, if it's right, we don't have to go back through everything. That's the beauty of Cengage. It helps us. Because if you were doing this manually, you'd have to add and re-add and re-add. So the total assets is the 12,950, the 2,000, the 4,600, and the 1,200. So when we add those together, we should come up with 20,750. See if that's right. Yep, I think it is. So total assets is looking like 20,750. If we were doing it manually, again, we would just run through the calculator, do that over and over until we got the same numbers 2 or 3 times. But we don't have to do that if we can do check my work. And then if it gets a glitch, we'll say, okay, what did I carry over incorrectly? All right, accounts payable number was $300. And then capital was 18,000. I was pulling from the bottom line here of my worksheet. And $100 was the drawing account. Service fees revenue was 3,300. Drawing account's a negative when you think of it as is included in the claims group or the equity adjustment. And then the expenses, also a negative when you're considering its impact on capital. So then I can add up everything on the claim side, which starts with the accounts payable, 300 plus 1,800 minus 100 plus 3,300 minus 750. I should come to that same exact 20,750. So I hold my breath. I touch the check my work and see if it's going to be nice to me. Yes. And so I look back to make sure there's not some little piece that's going to count off on me if I don't have it completed. Nope, check marks all over the place. Yes, I'm a genius. You have to tell yourself these things sometimes to get through the stuff. Okay, so we did that. I'm sorry, I can't pause and celebrate for very long because I got to get to this next part. So now what they do in the 10 part, your homework ended there. That would be where your homework would have ended in your version, but I'm going to go and carry it through to the financial statements. So for 10A, what they did is they showed you what we've already done. And they said, now use that to build this income statement. So that's what we're about to do. We're going to pull from that the ones that affect the income statement. So for an income statement, you always put the company name, and then under that, the words income statement, and then for the month end, or if it's a year, for the year end, and the date the year ends. And you start out with a heading that says revenues. And then you're going to, for the expenses, you're going to have a heading that says expenses. So let's go ahead and put that in there. So under that, you're going to list all the revenue accounts. In this case, we only had one. And that was this service revenue, service fees, and it was $3,300. And we had one expense, and it was rent expense. And we knew that because of the notations we had made. These are over here. That's where we went back and put the descriptions. And that was at $750. So well, all we had in this list of transactions was one revenue account and one expense. If there had been a lot of revenue accounts or likely a lot of expense accounts, we would list each one individually on the income statement. And so we have all the revenue is totaled at $3,300, all the expenses at $750. So we can have a net income. If the expenses exceeded the revenue, it would be a net loss, but it's a net income. And it's just the difference between the revenue and the expenses. And so when you take 3,300 minus 750, you should come to 7,550. Sorry, 2,550. Excuse me. Okay, so that's all for that one. Let me see what the check my work does to me. Yes. So this is good. Sometimes they'll make you fill out this top section too. So you really need to know how to do that also. All right, so good. So far, we've conquered that piece. Now the next one is continuing the same problem, same fact set that we already worked. And it's just showing us our work that we've done so far, showing us the income statement, and then it's asking us to now do the owner's equity. Well, there's a sequence that you do the financial statements in, and you must do that sequence or it's not going to come out right for you. You start with, you have all of your accounts either in a worksheet or in what's called a trial balance, which is just a list of all the account balances. And you build first the income statement. And then the bottom line of the income statement shows that net income. It's going to flow into the statement of owner's equity. And so we had to do income statement first. And that's why they provided it for you. So we can use this number 2550 in our owner's equity statement. So again, the heading is going to say the owner's name, statement of owner's equity is the title of the financial statement. And then it also says for the month of, because remember, it's these for a period of time. For the month of June, April 30th. If it had been a year, it would say for the year of whatever, 1992 or 2022. But anyway, so what we got here, we're going to take the beginning owner's equity, which in this case, this was his first year again. So we would have had a beginning balance of $0. And then we would add to that the amount that he invested. Now, I don't get tricked. Remember a minute ago, I said right here that this was the amount he invested. And they said, I put that it was an increase in capital, but really they wanted the amount he invested. And if we look back up at our financial statement, we'll see he invested $18,000. It's not our financial statement. Look back at our worksheet. The total investment then is still $18,000 because we started the year with $0. This is first year of operations. Okay, and then the next thing, the total investment is $18,000. So then we say, well, what impacted it after that investment? Okay, the net income did. Net income for April was from this financial statement right here, $2,550. And the withdrawals would have decreased it. That's withdrawals for April. Looking back up here, we see that withdrawals were $100. On these financial statements, you don't generally put a negative in front of them because it says the word less withdrawals, so that you know that you're going to be reducing it to get to 2450 right here. So it's be like a double negative if you put a negative in front of your 100 and you said the words less withdrawals. Okay, so equity is increasing because the income was greater than the withdrawals. So that we wind up with an ending balance capital at the end of the period. And it's going to be 18,000 plus 2450, which is 20,450. And I hold my breath until I see if they're going to give me the check marks. Yes, this is wonderful. So this is what you're going to be like too. It's like you might like be, oh my gosh, it won't work. But then when it does work, you are like, this is wonderful. I feel good about this and I can do it. And so you think it actually encourages you that it balanced. All right, one more we've got. We're going to take the same information and push it one more time into the balance sheet. So what we've got is they give us all the data that we just worked in these three problems. And so we're going to work with it. The income statement was first, then it flowed into the owner's equity statement. And then that owner's equity bottom line of capital is the number we need for our owner's equity on the balance sheet. So we're going to just drop it in right now while we're thinking about it, 20,450, because that's what just flowed out from this statement of owner's equity that we just completed. This 20,450 is what we need to do our balance sheet. So now the other figures we need for our balance sheet are just in the worksheet. The cash account balance, 12,950, the accounts receivable balance of 2,000. So let's just go ahead and pull them. Cash, accounts receivable. And so the cash balance was 12,950. The accounts receivable balance was 2,000. Okay, what's next? Office supplies, 4,600, and the prepaid insurance, 1,200. Okay, office supplies, prepaid insurance. For assets, the office supplies number was 4,600, and I'm just pulling that straight from the worksheet. There's no mystery about this. You can't just make these numbers up. You have to pull them from the transaction list. So you see that here's my cash, 12,950. Then 2,000 for accounts receivable, then 4,600 for office supplies, then prepaid insurance for 1,200 to end my assets. So that's what I have right here. Then I total all those assets together and I get 20,750. That's the same number I got the first time when I totaled my worksheet. And then I look back at my and see what else is not included. I've already included this revenue expenses because they are in my income statement. I've already included this capital and drawing because those transactions are in my statement of owner's equity. What I haven't included yet is this number right here, the liabilities, accounts payable, $300. So that's what they're waiting for. One more thing, accounts payable, $300. Now look at those two. I add liabilities and equity, so that gives me my total of claims. And it's going to be 20,750. When I add those two together, I look over at the asset number and it's the same. And I like, yes, congratulations, it balanced. So this is wonderful. So look one more time though at the statement. I didn't mention this, but see how his name, the company name or his name is at the top, J. Pembroke. Then the second line says balance sheet. It could also say the statement of financial condition. And then the third line, notice it does not say for the month of. Because it's not for a period of time. It is for a point in time, the last day of the period. And so the last day of the period is April 30th. That's why that's what the date is. It's right there. Okay, let's see what the check mark work does to us. Yes, it's got all the check marks. We're so happy. So we don't stop there. We look right down here at the bottom of the page and say, submit assignment for grading. And then you are about to submit the entire, yes, I want to do it. Just do it. And see what I got, 100%. Thank you for helping me. Anyway, so that's it. Then we just learned a lot of things around the problems that we were working. And so you're ready to do your homework. Go for it.